Well, good morning, everybody. This is the June 10.
Recording in progress.
Start that again. This is the June 10, 2026 meeting of the Board of Investments of LACERA. Thank you, everybody, for being here. The chair notices an absence of a quorum at this time, so we're going to put off the call to order, but we are going to begin with the Pledge of Allegiance. So I hope everybody will stand up and recite the pledge. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you, everybody. We're going to go to item 3, and that's going to be having Madam Secretary go us through the procedure for teleconference meeting attendance under SB 707.
Okay, I'm just going to take real quick. Ms. Ginsburg? Ms. Mead?
Here.
Mr. Kehoe? Mr. Fay?
Here.
Ms. Martin? Here. Mr. Gatto?
I'm here.
Ms. Martinez? Mr. Jones?
Present.
And Ms. Langton? Here. And Trustee Me will be participating under teleconference policy SB 707. Ms. Me, can you please confirm if there's any individuals 18 years or older present at your location?
Nobody else in the room. I'm all.
Thank you so much.
Great. A quorum being present, we're going to call this meeting to order. First item on the agenda is the approval of the minutes. That is item 4. Do I have a motion to approve the minutes? All right, without objection, we're going to proceed by unanimous consent. Seeing no objection, the minutes stand approved. Next up is public comments. That is item 5. Madam Secretary, do you have people here for public comment?
No.
No. All right. And that brings us to item 6. That is the executive update. Mr. Grable, the floor is yours.
Thank you, Mr. Chair. Good morning. So this morning we have a varied agenda, discussion about the budget, a legal update, an actuarial report, and an SAA item. So we've got a lot to keep us engaged. If we can start on slide 5, please. Thank you. So this page shows the returns for major capital markets through the end of May. And as we could see in the different rows, it's dividing those returns into different time periods going back 10 years. On the upper left, there is a chart about public equity, and that is, it shows the MSCI ACWI IMI, which is our global, it's our benchmark for public equities. And there we can see that May was another strongly positive month for public equities. Up 5%. Fiscal year to date, the index is up, and those numbers are correct, 25%. That's not, a month, a quarter, or pardon me, that's, not multiple years, that's a year. And one thing to think about when we look at the global equity market, the word global is in it, in that it is the broadest measure of public equity market performance, yet the index is effectively dominated by a handful of companies. We've discussed this frequently. It's dominated by NVIDIA, Apple, Microsoft, Amazon, Alphabet, Meta, Taiwan Semiconductor, and specifically those plus several other companies. The 10 largest companies account for over 30% of that index fiscal year to date return. So 10 companies out of 8,000 dominate the performance. And while that's the broadest measure, it's incredibly narrow in terms of what it is actually tracking. So, a couple of perspectives, one of which is, 25% fiscal year to date is fantastic. That's generated billions of dollars in gains for LACERA. And those billions of dollars helps us with our mission to members. So always take any profit. I'll qualify that, any profit that's legal. Because once again, that's fantastic. Another perspective is that the narrow aspect of that gain is concerning. Is it an anomaly? How long can it persist? The problem is when. no one knows when that tree stops growing to the sky. And those, I think all of us, watch financial news, watch the press, read reports, you name it. There are people who say they know, they don't, just turn, run, don't look back. They don't know. And neither do we. We don't profess to know. I think that's one of our strengths, that's part of our humility that makes us, excel. The narrowness of this return, and then once again, that impacts the entirety of our portfolio, I think is important for us to review as part of our strategic asset allocation exercise. I think it's important for us to look at our benchmarks, to look at our various allocations, because in many ways right now, diversification may be underappreciated. When you have such strong growth in the predominant asset category, that may cause people to underappreciate diversification. We also should look at the fact that we have a low relative weight to public equity, which may be the right positioning prospectively. Retroactively, obviously, you'd always choose to overweight that asset category that performs the best. It's too bad that we can't do that. Turning to slide 8, please. So this page shows the results for the pension through the end of April. We could see in the upper left that the monthly return for the pension fund was up 3.1% net. The market value below that of $92.3 billion through the end of April. That is a high watermark for the pension. If we can do a quick look into the future, based upon preliminary numbers as of the end of May, that 92.3 is closer to 94 billion. And then if you add OPEB to that, we likely crossed $100 billion in total AUM as of the end of May. So maybe with a new presiding chair, this is kind of like a great moment, attributed to a new chair of a meeting. But $100 billion is a significant moment for LACERA. Maybe the thing that once again keeps us grounded is that our liabilities crossed $100 billion, years ago. So I think that 100 billion is great, but we, are mindful that we're not at 100% funded. Cash equivalents in the bottom middle of $1.2 billion is right on target. Turning to the next page. Here we can see more detail about total fund performance for various time periods, our functional categories, and our benchmarks. We'll start at the top with the bar chart. Here we plot monthly returns in 1% bands for 120 months or 10 years. And from a return standpoint, April was one of the 10 best months during this 10-year time period. The table on the upper right has some interesting numbers that put that monthly return of 3.1% in perspective. Our expected monthly return from our last strategic asset allocation analysis is 60 basis points or 0.6%. So 3.1 is many multiples of that 60 basis points. And our mean or average return over the last 10 years is 74 basis points or 0.74%. So once again, 3.1% is far in excess of what we expected and what we've actually witnessed over the last decade. Over the last 12 months, the fund is up 15%. Once again, that's more than 2 times our actuarial assumption. We're far ahead of our capital market expectations in addition. And we are well diversified. I said before that diversification may be underappreciated. We are well diversified. We've had solid contributions from all asset categories. However, I'll pause with the statement that I've made several times over the last couple of years, or many times, is that private equity is the laggard. It's a continuing story that we've discussed. If you look at the 1-year period, you can see that we've underperformed our policy benchmark, and more than 100% of that underperformance at the total fund level is private equity. Yet we have a good private equity program. LACERA started making private equity investments in 1986, so 40 years. I'm not 40 years old yet, so it's kind of before my time. But over those 40-year period, there were several years that we didn't make commitments. But over that period, all but 5 years were above the median in terms of vintage year performance. So 1987, 1990, 1997, 2017, and 2018 were the 5 years where our vintage year performance was below median. That's balanced or more than offset by, over that 40-year period, we've had 12 years where we've been top quartile. And that includes our most recent vintage year of 2025. So there's a disconnect, where private equity is underperforming, our policy benchmark is impacting the fund as a whole, yet on a comparative basis, from a quartile ranking, a peer benchmarking, it's doing well. So that is a disconnect that we should look at as part of our strategic asset allocation. One thing to think about is the financial media, once again, talks a lot about a K-shaped economy, that there's a divergence where, the wealthy are doing well, the majority are not. We may have kind of a K-shaped market, K-shaped capital markets, where we have 10 companies that are driving performance. The balance of public companies and other asset categories are not participating to the same extent. And that's something that we can't lose sight of. Let's turn to slide 13 and OPEB. Thank you. And this shows returns for OPEB through the end of April. The trust was up 5% for the month, not the quarter or year, 5% for the month. The net assets of $6.1 billion is a high watermark. As of May, also we'll expect another high watermark. Next page. Like slide 9, this page provides detailed performance information for OPEB. The histogram chart on the top shows that April was one of the 8 best months over the past 10 years for the OPEB trust. As you can see, that this chart is very different than the pension chart, which is much tighter in terms of the distribution. The OPEB plan is much more volatile than the pension. There are higher highs, lower lows, and the standard deviation, which is a measure of risk, and you can see in the chart on the upper right, it shows that standard deviation of 3.1. That compares to the standard deviation of the pension of 1.94. So it's a much more volatile plan than the pension. And that's a result of higher exposure to public markets, which are more volatile given favorable accounting for alternative assets, private assets, which are marked less frequently. The last 12 months return for OPEB is 17.6%. If you go down that column, you see it's 32.2% for growth. That's, once again, is just an outstanding number that we can see. And let's finish the discussion on page 21. And I'll discuss this page given the actuarial discussion that we're having this morning. This page details the change in our fiduciary net position. There's important information. It reminds us that we are a mature plan, that we are cash flow negative. On this, we could see some towards all the way on the right side, a strongly negative and a strongly positive number. March was a very negative month in terms of cash flow as global markets retreated. There was a significant recovery in April, as we just discussed. And maybe this, you look at March to April, maybe that is the reminder as to the importance of diversification, that there are major consequences to mistiming the markets. In hindsight, it looks easy, but arguably it's reckless prospectively because none of us know when markets can shift the way they have in March and April. And with that, Mr. Chair, I'm happy to pause for questions.
Thank you. Questions from the board? Ms. Mee.
Hi, good morning. Thank you, Chair. Thank you for the report, Mr. Graver. It's an exciting month. I just want to add a comment on the private equity. So private equity situation, we're not alone. All the pension funds are about on the same boat that the performance, the benchmark is a little bit of mismatch in what for private equity as is referencing to the global market, and the global market is doing global equity is doing really well. That's why it looks a little bit off. So, but we're not alone. So every other pension fund facing the same situation, it looks like that. The other one is I have a question on, not a question, more like an observation on slide 6. So here, top right corner, just observation, welcome comments and discussion on this. So I'm looking at the unemployment rate looks stable. However, what I noticed is that the labor force participation rate, the labor force participation rate is significantly lower than normal. So I'm wondering if the unemployment rate is because the less people participate in the market, it's not necessarily how good the job market is. Just observation, welcome discussion. That's all I have. Thank you.
Thank you, Trustee Mee. Seeing, Mr. Fay.
Also on the private equity thing, diversification, we can't all be in AI for everything. So I feel better about that because it shows that we're not correlated. When things go sideways, we won't be correlated to that as well, which just means that we're gonna look smart. So month to month is great, but that's why public markets are always trying to go up and down because everyone's trying to figure out something right way. We're supposed to stay the course. That's just my 2 cents.
Great, thank you. All right, we're gonna move now to the member spotlight.
Morning, everybody. Thank you very much. So the member spotlight. This is where we take a moment to recognize the public servants that care for the constituents of LA County. It's also an opportunity for us to reflect on what we do and why we do it as we serve our members and empower them to a healthy and secure retirement. So this month, we're going to continue a trend that we started last month, just recognize some of our own staff members who are public servants. And I think that's really important because, we are in the same category as the people that we serve. It means we're connected to them and we understand them, and we're here to support them. So this month, we're going to recognize Bernie Buenaflor, who was our Chief of Quality Assurance. Bernie retired last month after 26 years of service. Bernie has been an integral part of LACERA for a long time, really building up our focus on quality and process improvement. He is actually my partner when we started out with the process management group, which has been a great benefit to helping us improve our processes internally. That was our brainchild that we came up with a long time ago. His proudest accomplishment is shaping the collaboration among LACERA member operations group, and that's been a critical importance of what he's contributed to the organization. So he's relocated to Arizona. He's got a nice little, I want to call it like a compound farm type thing there. I've seen pictures of it where he's looking to enjoy that rural life for a while and fulfill his lifelong dream of living that simple life and with his animals. So thank you very much, Bernie, for everything that you did for LACERA and for our members, and we appreciate you.
All right, let's go to the CEO's report.
Yes, good morning, Chair Gatto. Good morning, trustees. A few updates on my end. First, the 2026 general election. Teams launched a campaign both educationally and also communication-wise on the general election for both the BOR and the BOI. Candidate filing period ends June 22nd, and then we also start the voting August 3rd. We're going to continue to keep the board apprised of the election all the way through the Board of Supervisors selection or announcement on sometime in October. If we go to slide 3, please. I talked last month on our LA County legislative visit to Sacramento on May 6th, so I won't delve into that. But what I will say is we talked about the economic impact study. So the last time LACERA did their economic impact study was 2022. We concluded and updated those numbers for 2025. We provided a report to the Board of Retirement last week, so we'll be sharing that with the Board of Investments in terms of that full report. But some highlights from that report that I want to mention is statewide, LACERA retirees have a over $5 billion impact in terms of economic impact throughout the state, over $3 billion locally in the LA County economy, and also about 83% of our retirees still call California home. And of that, 67% still live within LA County. So still making meaningful contributions outside of their active work career. So we'll certainly be communicating that. We have a communication campaign that we'll be releasing over the next week or so to spotlight that. And then just finally closing out, as this is the last board meeting of the fiscal year, I just want to say, as John mentioned, a couple of high watermarks on the pension OPEB side, but also our funded ratio as of the last actuarial eval is at 82%. While those are great numbers, we all stay grounded on the fact that our unfunded liability still sits at 18 billion in the pension and 22 billion on the OPEB. And I know that collectively keeps us focused on the larger goal at hand. So with that, I'll stand for any questions with respect to the report.
Questions from the panel? Seeing none, I'm going to release our executive team, and we're going to move forward in the agenda. Gotcha, sure. Okay, Chair's prerogative, we're going to take our non-consent items out of order. So we're going to go to item 8 on the agenda. And that is our fiscal year 2026-2027 proposed budget. Welcome, everyone.
Good morning, Chair. Good morning, Board. So happy to be here today to present our budget. This year, we aligned our budget with our strategic plan to ensure every decision we make strengthens our support and delivers for our members. So as we focused on that, we really focused on making sure that there is that alignment for our strategic plan. So if we can push ahead to the slide deck. And jump ahead to slide 5 real quick. Or 7, I'm sorry, slide 7, sorry. So as you see, we kind of talked about this already this morning a little bit, but really aligning to it, right? And you see that we're aligning around our goals, and our investments are really tied to that, right? Of where we're putting our money to ensure that we're strengthening our members' experiences, really innovating through technology, right? Using technology to help us move forward, to speed up processes, to do things better, and making sure that we have that thing. We're investing in our people. I know it doesn't have it's a unique tweak on how we do that, but we are investing in our people to make sure that we have the right people at the right place at the right time as we deliver forward. And then we can never forget about ethics and compliance, and then our fiscal durability, right? So next slide, and I will turn it over to our team over here to help me go. Ricky.
With that strategic context, I'll now transition to the administrative budget. Sorry about that. Good morning. I'll start over. So with that strategic context, I'll now transition into the administrative budget, starting with the assumptions that guided how we built the proposal. This slide summarizes the key assumptions. Filled positions are budgeted at current salary levels with approved step and merit increases. Vacant positions are conservatively budgeted at entry level and phase based on hiring timelines, and only approved labor agreements are reflected. No speculative increases are included. Overall, these assumptions ensure the budget is realistic, disciplined, and aligned with current conditions. Next slide, please. My notes don't want to move. Okay, the proposed administrative budget totals approximately $151.6 million, representing a 3.7% increase year over year. At a high level, the budget supports the full scope of pension administration, member services, financial operations, technology, compliance, and risk management. From a composition standpoint, salary and benefit costs remain stable, while the primary increases are in services and supplies, largely driven by contractual obligations, compliance needs, and targeted technology investments. Importantly, the budget remains well below the statutory cap, maintaining strong fiscal discipline. Next slide, please. Salaries and employee benefits reflect a disciplined, stable cost structure. Growth is driven almost entirely by benefits, about a $2 million increase consistent with county assumptions. And while salaries remain essentially flat year over year, any increases are limited to the approved step merit and labor agreements already in place, no new assumptions. Staffing remains controlled with vacancies budgeted conservatively and phased in over time. There is no expansion. This is about sustaining critical operations. Bottom line, predictable, controlled, and aligned to maintaining workforce stability without accelerating costs. Next slide, please. For services and supplies, this is where we see targeted increases. The key drivers are technology investments, compliance requirements, and contractual cost pressures, all tied to maintaining system reliability and managing operational risk. At the same time, we built in offsets through reduced temporary staffing, elimination of one-time costs, and tighter discretionary spending. This is not a broad-based growth, it's strategic investment paired with active cost control aligned to long-term sustainability. And now I'm going to turn it over to our Chief of Information Technology to talk more about that.
Thank you, Ricky. Good morning. So you've heard information technology a few times during the presentation so far. So I want to highlight the spending plan for IT for next fiscal year. You can see that there's a planned increase of 8.4%, and this is to continue investing in technology as well as continuing to support our operations. So we really have two buckets when it comes to IT spending: running the business and changing the business. I want to highlight that we do have a governed process for intaking projects. We have a committee internally. It's called the Information Technology Coordination Council, and it's an IT steering committee. So all projects are presented to that group and approved or disapproved. In addition, we do align them to our strategic goals. So we have 5 strategic initiatives at LACERA, and every single one of them has a technology component to it. And the third thing I want to highlight is that we are constantly looking at the value we're generating. We are mission driven, so we're not trying to increase sales, but we are trying to improve the experience of our members, reduce processing friction, have more efficient processes, and reducing our technology debt. A few of the projects that I want to highlight for next year are our new call center solution, which will greatly improve the member service and also improve the experience for our call center. In addition to that, we do have a digital assistant that we're launching. We're launching the project, not the actual app, but that will be a big focus for us for next year. We want to meet the members where they are, whether they want to use a laptop to interact with us online, if they want to use their phone, an iPad, or if they just want to come in the front door. We want to meet them where they are. 2 other projects that I want to highlight because they're multi-year projects and they do require temporary staffing that's different than what we normally do. The temporary staffing is dedicated to these 2 projects. One is our mainframe migration, and that really is a big return on investment. When that project is completed, we'll have a significant cost savings immediately. And then the other one is our business intelligence initiative. We do have temporary staffing for that. And the goal of that project is to give every decision maker a dashboard so that they're not using reports that are emailed to them or constantly asking for data. It will be readily available for them in live data in a dashboard. And so with that, I'll pause for any questions you might have about the IT spend before I turn it back to Ricky.
Quick question.
Sure.
Not question, comment. I'd love to dig more into this with you later on, like not for right now, but I enjoy this kind of stuff. So learning more about what the kind of systems we're doing to be more efficient. I think that the spend is necessary, but definitely the how is fascinating.
Thank you.
Other questions, comments? All right, let's proceed with the rest. Thank you.
This we look at HR, right? HR is obviously a key factor for us because people make things happen right around here. And so these numbers kind of look, if you go to Pat, 3 more slides down, please. 1 more, there we go. You look at our numbers are as of April. The one thing I will highlight, we hired 20 people in May to include myself, right? So that's a great news story, right? We're getting really close to that 45 number. We're working hard, that HR team is working hard with as a team sport with our managers to fill those gaps and bring people in at the right time. One of the best things I will say is we don't have a problem attracting good candidates. It's really, it's not a quantity issue. It's really making sure that we tie down that quality to get the right person. And so everybody's working on that, making sure our job analysis is done correctly to get to those right people. We also recognize we had a bump in retirement this year. It's not kind of unusual when you start look into the back demographical numbers. We had a little bit of rise in our workforce age this year, going from about 62 to 64, which then that's really that sweet spot in that number to see people drive up on our retirements. We get there. If you can go 3 more slides to our future retirement. So 1 more. We also keep an eye on the future, right? Because it's about succession planning, right? Building our bench for the future. And so as we kind of look at this, we recognize that, hey, over the out years, we have about 30 people that are going to probably punch the ticket and retire. And we're going to work to build those benches and building succession plans. One of the things we're highlighting this year is our leadership track and developing those 5 tracks to make sure that we have people ready to succeed in these positions. And I'm really excited for that. And I'll turn it back to Ricky to talk about our last 2 issues.
Thank you very much. If we can go to slide, yes, there we go. The Retiree Healthcare Benefits Program budget at approximately $3.8 million supports the administration of retiree health benefits, including enrollment, eligibility, and member support. This program is funded through administrative fees, not pension trust assets, and ensuring clear cost allocation and transparency. So if no questions about retiree healthcare, we can go to the next slide. The OPEB trust budget at approximately $1.2 million supports the board's fiduciary role as trustee. While modest in size, it enables critical functions such as investment oversight, financial reporting, compliance, and governance, ensuring responsible stewardship of retiree healthcare benefit assets. Together, these budgets reflect a consistent approach, maintaining strong service delivery, supporting governance and compliance, and ensuring appropriate oversight of both operational and trust activities. In summary, the full fiscal year 26-27 budget package is disciplined, strategically aligned, and fiscally responsible, balancing current operational needs with long-term sustainability and risk management. Staff respectfully recommends that the Board of Investments adopt the fiscal year 26-27 proposed budget as presented. Thank you, and we're happy to take any additional questions.
Thank you for the concise presentation. Do we have questions from the board? No additional questions. That is amazing. So thank you very much. I guess then I will entertain a motion to approve the fiscal year 2026-2027 proposed administrative retiree healthcare and other post-employment benefits OPEB trust budgets.
I'll second.
Great. We have a motion and a second.
And then-
Madam Secretary.
Can we go and do the consent items?
Yeah, we'll do that.
Okay.
Madam Secretary, please call the roll.
Okay. Ms. Mee?
Yes.
Mr. Fay?
Aye.
Ms. Martin?
Aye.
Mr. Gatto?
Aye.
Mr. Jones?
Aye.
And Ms. Langton? Passes unanimously.
Terrific. We're going to go back to item 7 on the agenda. That's the consent items. Do any trustees wish to remove any items from the consent calendar? Seeing none, then without objection, we're going to approve this matter on unanimous consent. Seeing none, item 7, the consent items stand approved. Okay, moving right along, we have reports. Looks like a large variety of reports. This is item 9 on our agenda. Or two presentations out. Welcome. Floor is yours.
Well, good morning, Chair Gatto and trustees. So the next item we have builds upon our strategic asset allocation study that we kicked off at last month's meeting, where we outlined the overall process, key objectives, and timeline for this review that will take place over the next year. So as a reminder, the strategic asset allocation is one of the board's most important responsibilities. So it serves as the primary driver of the fund's long-term risk and return outcomes. And the study is also designed to ensure that the portfolio remains aligned with our investment beliefs. And it's also helps us meet our long-term obligation to produce, protect, and provide the promised benefit to our members. So today's session is intended to provide additional transparency into the analytical framework and modeling methodologies that will support the development of the asset allocation alternatives over the coming months. Specifically, it will introduce a range of tools and approaches that will be used to evaluate different portfolio structures across varying market environments and economic conditions. So if we can turn to slide 2, I'll cover the first portion of the slide before I hand it off to Tim. This slide mentions here, shows how the context of how our study and how this all fits within the board's governance responsibilities and LACERA's broader investment framework. So the board is responsible for establishing an investment policy statement and then determining the appropriate asset allocation for both the pension and OPEB trust that's consistent with our fiduciary duties. So in alignment with the investment policy statement, LACERA conducts a comprehensive asset allocation study every 3 to 5 years, and or at the board's request, and the last one was completed in 2024. And this current study continues that deliberate, disciplined, and periodic process. So LACERA has historically applied a multifaceted or mosaic approach to asset allocation, incorporating multiple analytical perspectives to evaluate trade-offs from risk, return, liquidity, as well as our funded status outcomes. So the key point I want to make here is that there is no single right asset allocation. Instead, the process is designed to provide the board with a range of informed perspectives and potential outcomes to support sound decision-making. So with that context, I'm going to hand the presentation over to Tim Phillip from Makita Investment Group to walk through the methodology, the analytical framework, and as well to complete the rest of this introduction slide.
Thank you, Jude. Mr. Chair, fellow trustees, thanks for having us here today. I'm just going to kick it over to Ison here in 1 second, but I did want to highlight on this page, in line with the objective of this presentation, it's meant to be educational. So the portfolios that we're presenting in here are just example portfolios. We use one that's a diversified portfolio that would be similar to what LACERA might consider, and then a more basic reference type portfolio. We use those consistently throughout the portfolio. We do have a couple of abbreviations as we tried to make the slides appear a little prettier. So just wanted to note that global equity is abbreviated to GE in the presentation. Investment grade bonds, which is your traditional fixed income allocation, is noted as IGB just to make the charts a little prettier. And with that, I will turn it over to Ison.
Good morning, all. I'm Ison Killick, and I will be walking over some of the pages for this presentation for the strategic asset allocation. If you can go to the next page, please. Before we dive into some of the elements and processes that will be involved for strategic asset allocation, we would like to just take a few minutes to review this page, which shows the secular changes in investment returns, both in terms of expected returns and actual realized returns over time. On this page, you see a chart with bars representing the expected returns for equities and bonds, and then a standard balance portfolio. And then the actual returns over time that the markets have realized on these asset classes and balanced standard portfolios, which are the rectangle looking ones, sorry, lots of words here. And what you can see, the main takeaway from this chart is that this chart illustrates that a portfolio looking at both the individual bar charts and the combined standard balance portfolio, has produced diminishing returns over time, as well as the actual returns over the past years. So the reason we want to point this out is your job is getting harder. Back in the 80s, it was perhaps easier, especially with the boost of the fixed income returns, to come up with a portfolio to meet your objectives for returns. And your job is even more important now to get to that. Next page, please. Tying it to the capital market expectations, which is a very important input in the strategic asset allocation process. This page has a little print, a little write-up. What we would really like to point out is towards the middle of the page, the bullet point that couple of reminders. The capital market expectations is something that Mikita and a lot of consultants prepare annually. And it's forward-looking, usually produced sometime around January, looking at the end point the year before, so December 2025, for the capital market expectations for 2026. We update these annually, and we do it over 100 asset classes. And what we're seeing is that, in general, for 2026 capital market expectations, the return assumptions decreased for 80% of the asset classes for the 10-year, and nearly 90% of the asset class over the 20-year. As a reminder, we project both for 10 years and 20 years. So our lower return assumptions over the 10-year horizon implies that investors might be well served by moderating return expectations going forward for the next 10 years. That also makes sense given how strong the markets have been and how going forward, can the markets keep such strong returns? Likely not. So with that, if we can, I'd like to also point out that we update this every year. So once we're working on the specific strategic asset allocation numbers for LACERA, we will be using next year's. So it will be more seamless in terms of using the latest capital market expectations for coming up with a strategic asset allocation for your next implementation. We will review those in more detail for the 2026 in August. Next page, please. Before we dive into some of the scenarios and the sample portfolios that Tim mentioned earlier, we just want to remind that, as was mentioned in the introduction, we use a mosaic theory. We use more than one model. No model is perfect. And it's good to look at various models, combine and come up with understanding various scenarios and understand various outcomes. So this page has a list of various models that are utilized, and the following pages show the samples. So if you can go to the next page, please. I will go through these pages relatively quickly, but please feel free to stop if you like. These are sample portfolios, showing 4 sample portfolios per page, and showing you what kind of different analysis and scenarios we look at. So this being the mean variance, the modern portfolio theory, very commonly used, and you can see various the return expectations we can have over various time periods. Next page, please. This is another outcome from the modern portfolio theory, looking at, again, mean variance tool, and looking at, sometimes we say at 10% confidence, how much can we expect to lose? And even looking further at that tail risk. But this page basically shows the value at risk at assumed percentage. Next page, please. This is an important page as a reminder that another way to look at things is the risk budgeting analysis. And you can look at a simple portfolio versus a diversified portfolio, regardless, given the risk and return, especially the return objective. Risk typically dominates the overall risk contribution to a portfolio. So even how you slice and dice and introduce additional asset classes for expected return aspect, risk typically dominates the overall, the growth asset class function. Asset class usually dominates the overall contribution to the overall risk of the portfolio. Next page, please. In the next few pages, we show the scenario analysis in terms of looking at both historical actual events that happened in the past, and given the sample portfolio, how we can expect those portfolios to behave if history repeated itself. Just some of the major market shocks that the markets have experienced in the past. So you can see some of the returns here. And then next page, to balance things out, also looks at the positive scenario analysis. For the next page, please. So to balance things out, again, we look at both the negatives and the positives. One thing you can regularly see is that diversified portfolios tend to do the best. And the portfolios that tend to protect the most in downside don't participate usually as much for the upside. Next page, please. The scenarios we just saw were the actual events from the past. We also use our modeling to see hypothetical cases and basically looking at various types of if equities rose, if equities declined, if the interest rates rose or declined, if spreads narrowed or widened at certain percentage points, basis points, how would the portfolio behave? So comparing again, actual events versus some hypothetical cases and seeing the upside and downside again. Next page, please. In this page, I will turn over to Tim to talk about the liability.
Just a couple questions before you do that, if I may. So, you know, the modeled, the backwards looking model losses and the backwards looking model gains are almost too good to be true. And that just, you know, I guess what I'm saying is like, you know, if MPT was like a silver bullet, then like no pension would ever have a loss. And so it just strikes me like, I mean, you know, and I know that our CIO has talked about this a lot of times, that's like, there's like known unknowns and there's unknown unknowns, but when you get into the category of unknown unknowns, which is what will the next crisis look like, talk a little bit about, do you think these numbers will hold true?
Are you referring to the MPT pages?
Yeah, the pages you just went through, that back model, the you know, the maximum loss based on our planning. It just seems like when you're in the category of unknown unknowns, it's impossible to truly, you know, understand what those losses could be.
Yeah, maybe we could just back up to slide 6 real quick, and we can have that up on the screen to talk through. So here, I mean, you do see, you know, in all of the sample portfolios, losses that get into the double digits on the 1 year, right? And so that's a realistic thing that you have to face. Is that as bad, let's say, as what we went through with the GFC? No. So that's why we utilize those tools. At the time, all of the sort of buildup and leverage was the unknown that impacted markets. And so modern portfolio theory will never be able to address that. But you do see over time, you're looking back at all the performance that does ultimately roll into the calculations that are forward looking. They're just, you know, academic models, but they're based on the historical performance of each of the underlying asset classes, the relative underlying valuations at the time, a whole bunch of other things. So that's why we do utilize that tool. And then we also have the theoretical scenarios, and we also have a number of these ones we've articulated are our standard package, but we do look at others, whether it be a deglobalization scenario, some other things. So our research teams do try to anticipate what the next set of risks are, but of course, you know, we're not necessarily always going to have the crystal ball to perfectly identify the unknown and build the portfolio for it. But that is a part of it that we're trying to contemplate as we go through time. But certainly you are the ones that have to contemplate how much risk you're willing to take, knowing that you do invest in a world that involves a tremendous amount of risk.
For sure. I'm curious how extensive those risk models are. Like, do you ever do something where you model something where like the price of a barrel of oil goes to 150, there's widespread geopolitical conflict, you know, and the AI bubble pops, all things that in theory could happen?
I know we run those in isolation. I'd have to see if we kind of combine 3 type scenarios like that, but we definitely have, you know, strong inflationary scenarios already built out. We have the deglobalization one. We've certainly looked at what happens if the AI bubble or the sort of AI run up were to unwind, depending on your perspective on where we are in that process. and we can get into that. But yeah, that's one of the things. Once we do some of the survey work that we're going to do with you all and have some of these additional conversations, that's going to really highlight some of where your risk focus might be. And then we'll try to address those in the portfolio design when we keep coming with the refined portfolios later in the process.
Gotcha. All right. Thank you.
Awesome. Any other questions? Okay, we'll jump forward to slide 12 then, please. So here you can start to see some of another approach. This is when on one hand, you're looking at the asset only returns is what Eisen was mostly talking about. Here we try to incorporate what also happens with the liability side of the portfolio. So it starts off with a tremendous amount of modeling. And so what you see on the top left, the spaghetti chart there, that's essentially one portfolio running through, we can change the number of simulations, but I believe that one was using 10,000 different simulations to show what that hypothetical performance over long periods of time would be. And then we've refined that into the bottom chart where we put it into like corridors that you can see, okay, within certain levels of confidence, where is LACERA likely to end up at the end of the projected period. So the idea obviously for you all is to keep improving on the funded status, and that's one of the things that we focus on, but there are lots of other ways to think about optimizing it. And on the next slide, you can see a little of that. So this is looking at, instead of doing 10,000 simulations on one portfolio, this is looking at long-term expectations for 15,000 different asset allocation combinations. So think about changing the weightings of every asset category under the sun that you could put in your portfolio, plus or minus a couple of percent, and running those through the same sort of mean variance optimization process. And you really are trying to identify where you're optimizing for. So this is long-term funded status on the left-hand side. So higher is obviously better. And then on the bottom one, it's short-term downside in funded status. So basically also taking into account protecting on the downside risk and avoiding some of the short-term volatility. So as you move up and to the right, those are optimal portfolios, and we'll discuss that. And then we use the sample, the tools of the survey that we're going to do next. And I know you guys are probably a little bit surveyed out right now. So we're going to take a break until October on the survey. But ideally, we can identify a couple of strong risk factors or things that you all want to optimize to, and then we can really incorporate that into the types of analysis that we present on helping you choose which is going to be the optimal portfolio for LACERA going forward. Next slide, please. This is something that we started collaborating with LACERA on. These are climate scenarios a couple asset allocations ago. We had done some early work on this with one other East Coast client. We worked really closely with Scott and team on some things that he would like to see in the analysis. The last asset allocation, we also brought in some additional external models. So it wasn't just looking at what our theoretical climate scenario models are. There are some other data providers out there in the marketplace. So we incorporated a few of those. You know, we talked a little bit about the unknown risks. Climate change is certainly one of those, and it impacts different asset categories differently. You can see that on the next slide. We have these box and whisker charts. So it basically just shows you how potentially large the impact could be in certain asset categories. There are some obvious places where you would think about risks being higher, coastal real estate, if you want to look at it on a very granular basis. But typically your more volatile asset categories are going to also experience more volatility under some of the uncertain scenarios with climate. So typically this hasn't been a determining factor in LACERA's analysis. So we call it climate aware asset allocation. And it just shows that you're thinking about these things, which are uncertain and certainly can change, but will have impacts on asset prices in the future. Next slide. We'll also perform an in-depth liquidity risk analysis as your CIO pointed out this morning, LACERA is a mature pension plan that's cash flow negative, so it has to pay benefits. You have utilized a decent amount of private markets to provide additional diversification and return enhancement opportunities. So we'll just run through a very draconian stress test to show you all that you can feel comfortable with the desired level of privates that you select. Ultimately, the exercise tries to determine a scenario under which LACERA, or a threshold under which LACERA would have to be a forced seller, which you don't want to necessarily do. You want to be strategically rebalancing in those types of environments, and maybe pursuing some of the opportunity sets and not having to worry about raising liquidity to pay benefits. So that analysis helps check that box for you all. And then on the next slide, please. Economic regime management is sort of another one of these that we can talk about. How do you deal with the unknown unknown? So we do 4 broad types of economic environments into the future and explore how various different portfolios act under those. We do have the ability to tweak those regimes a little bit. So that's something we can talk about after we get the survey results, if there are some other things that you all are concerned about. But these are the sort of 4 general buckets that we've identified that can be significant regime changes over time in markets. And then next slide, please. Just wanted to land the plane here on the strategic workflow. So this is what we have. It's basically every month from now until you all vote on the new strategic asset allocation, most likely in April of next year. Some of it's educational, and then we really start getting into the work of reviewing the portfolios once we get into the 3rd and 4th quarter of this year. We do understand that there can be some board turnover at the end of the year, so we'll also do like a refresh session at the beginning to make sure any new trustees get reoriented, and then we'll go into our 2027 CMEs, and then some in-depth reviews of portfolios. But we try to take a very deliberate approach, make sure that you all are thoughtful about it, as been highlighted multiple times. Strategic asset allocation is the thing that determines the vast majority of the outcomes for pension plans like yourselves. So we take this process very seriously, and we look forward to working on it with you all.
Terrific. Thank you. Yes.
I just want to say thank you for presenting such an array of lenses. I think when the time comes, it will really help us be comfortable in our final decision. So thank you for that.
Any other questions, comments? Seeing none, thank you very much.
Thank you.
Okay, that brings us to items 10, items for staff review.
No, actually.
Oh, I'm sorry. We have our actuary reports. We're still on item 9. Welcome, gentlemen.
Great, thank you. Glad you didn't forget about us.
Who could ever forget about the riveting field of actuarial science?
So I know that in the last presentation, Mr. Perez pointed out that the strategic asset allocation is the most important thing that the board does. I'd like to offer that the actuarial study and looking at the liabilities is also very, very important. As an accountant, I can't help but mention we're talking about assets. Obviously, the board's focused on that a lot. We also need to focus on liabilities, and I think the board does a good job. And so we're going to talk a little bit more about that today. We're here to talk about the risk assessment report. Craig Glide is with us from Milliman. He's a long-term consultant, a principal and actuarial consultant on the LACERA engagement. And we're going to talk a little bit about the report and go through sort of the highlights of the report. I'll start off with a couple of comments. The risk profile and information, there is some of that included in the annual actuarial evaluation report. This is a separate report where we sort of expand the risk discussion, and we go through an entire report just to talk about risks and the associated controls. Broadly, this report touches upon risk in measuring pension obligations and liabilities, also risks associated with determining future contributions, and finally, risks of varying financial outcomes. We were talking earlier, John was talking about unknowns. And so we're looking at measuring risks and also measuring controls and trying to figure out what happens if things go off the rails, if you will. This report essentially is an educational opportunity for the board. We're going to spend a few minutes talking about it. As I mentioned, there's no decisions to be made today, so this is just information. This is sort of our mid-year touch point in terms of actual concepts. Our last report was the evaluation report in March of 2026 that the board adopted. Our next report will be, I'm sorry, for 25, did I misstate that? For 25, the next report for 26 will come to the board in December. So this is kind of that mid-year sort of touch point. Let's talk a little bit about actual concepts. And finally, I'll just mention, I do appreciate the board's engagement and participation. This wraps up the 2025 reporting cycle. We started out in September at the board offsite talking about actuarial concepts. We had Nick and Craig and Alan presenting some of the actuarial concepts. We started talking about economic assumptions. We followed up in October. The board approved that report in January, and again, the evaluation in March. So this essentially is a little bit of a journey, and we do appreciate it and the board's engagement in terms of the triennial year. That's what we're wrapping up. With that, I'm going to go ahead and hand it over to Craig to get started on the slide deck.
Thanks, Ted. Good morning. Very happy to be here and continuing the discussion on risk. We've talked a bit about that already this morning. So there's terms that have already been thrown out, that the unknowns, the no crystal balls, nobody knows what's going to happen. So you might hear some of that same narrative from me this morning as well. But this is tying it back now more into the valuation and the liabilities and the assumptions that we use in the valuations and what risk is inherent when actual experience doesn't follow what we thought it would and the assumptions that we set. So when we do the valuation each year, we do that based on one set of assumptions, our best estimates of what we think is going to happen over a period of time in the future. That's all based on the triennial experience study that we just completed earlier this year. But the one thing we know pretty much for sure is that actual experience is going to be different than whatever that single set of assumptions is that we come up with. And that comes down into the no crystal ball. Nobody really knows what's going to happen. But we want to try and provide information to you because it's important to understand what impact does it have on the financial health of LACERA when experience doesn't match what we thought it would. So we give you projected contribution rates and projected funded ratios, but then life happens, and what impact does that have on LACERA? So my main goal today is to provide you some information to help you understand the sensitivity of contribution rates and the funded status and the financial health of LACERA under different scenarios when actual experience doesn't meet the assumptions. We could move to slide 5, please. So there's a lot of reasons why actual experience isn't going to meet the assumptions. We know there's a lot of macro risks out there. We know just this morning there was a new inflation number, that inflation came in at over 4%. Our long-term assumption in the valuation for national inflation is 2.5%. So we know that over the long term, when we're setting our assumptions, we're trying to look long term. We know there's going to be short-term volatility, but hopefully over the long term, our assumptions are going to roughly match. But there's a lot of reasons that the experience can differ. And so what I'm trying to show here is just give a couple examples of how some of the macro level risks sort of cascade and filter through into specific risks for LACERA. So right now, we have a lot of geopolitical events happening. There's a lot of government policies moving around. We've got a new Fed chair. There's a lot of things that could affect the overall environment that we're operating in. It can affect the stability of financial markets, can affect inflation, just levels of overall participation and investor confidence. So that ultimately filters through and translates to risk on LACERA through inflationary risks, which then can cascade into salary growth and payroll growth and retiree COLA bank risks, and obviously affecting the investment return that LACERA earns as well. And ultimately, the investment return, whatever the actual experience is, that's the biggest driver of sort of that sensitivity to rates and funded status in the future. We know also that there's some labor market impacts that can have an impact, have an effect on LACERA. I think over the last several years, there's been some challenges just with the employers, the counties, especially their ability to fill some positions. And so that can have an effect on the payroll base and the payroll of the LACERA, the county's membership and is working with. And that's important because the unfunded liability is amortized as a percentage of that payroll base. And so if there's potential difficulties hiring and retaining people that leads to a lower payroll base, then that's going to lead to higher employer costs as a percentage of pay. Difficulties with hiring can also have impacts on levels of salary increase and just the incidence of when people are retiring or otherwise leaving LACERA. There's legislative risk out there, just specifically right now on Assembly Bill 1383. That is working its way through the Senate. If that passes in some form, I mean, the proposals that are out there would lead to an increase in the level of benefits. That's obviously going to, prospectively, at least in the level of benefits, that's going to lead to higher employer and employee costs, both as a percentage of pay and a dollar.
Quick question. So 1383, that's the PEPRA reforms?
Yes.
Got it. Okay. Thank you.
So any type of legislative risk, anytime the law changes that changes pension benefits, is going to have an effect. We don't necessarily know exactly, but we know that this specific one moving through will likely lead to higher costs. It could impact salary increases and payroll growth again, and also could affect the incidence of people either joining or leaving LACERA at different times. Next page, please. So in this chart, we are trying to rank the different risks that LACERA faces through the assumptions that we're using. This is the same chart that we included last year. Everything's in the same place as it was last year. We know that this is all very fluid. This is not intended to be very sort of exact. It's more our judgment, our opinion of sort of the relative level of risk of each of the assumptions. You see on this one, investment risks way over to the right-hand side. It is the one that is going to have the highest level of risk as far as contribution rates and funded ratio of LACERA. We have legislative risk in there as well, just with the movement of that bill going through Congress, through the Senate. I think there's a reasonable chance that something comes out of that. And so that is going to create some additional cost and risk.
Quick question on that, Craig. Did it cause you to move that legislative risk box either way, just that one bill? Did that cause a significant change in that risk measurement?
Well, last year was when we added that risk onto this chart. We didn't have it on there before because there was nothing out there that we were aware of. So we added the legislative risk last year for the first time. We didn't move its position this year on the chart. I think our overall opinion on that right now is that risk is stayed about where it is. There's not been a significant change in the impact we think it will have this year compared to last year.
Great, thank you.
And just as we sort of move to the left end of this chart, the contribution risk that we have in here, that is generally going to be the risk that the employers don't pay the recommended contribution. We know there's been some financial pressures on the county of late. We don't have any information to suggest that they aren't going to continue to pay the contributions, and they definitely have a strong history of doing that. So we think the risk of that is still relatively low, but we are paying attention to that over time. And finally, the retiree COLA risk, even though that's tied to inflation, inflation is very volatile right now, because there are some caps on what the maximum retiree COLA can be, there is some protection there. And so there's the actual risk on the valuation is not as high, is fairly low on the COLA risk.
One thing I'd add to the retiree COLA risk, Craig, is that we also sort of budget for regular retiree COLAs. Yes. In that COLAs are built into the contribution rates that members pay.
Yes, correct. Yes, we have that built in, the assumption in the valuation for those. And so that filters its way through all the costs. Yeah.
Thank you.
Next slide, please. So although we're generally looking forward here, sometimes it's helpful to look backwards a little bit at what happened. The main chart here is showing you a 20-year history of this impact that different experience had on the unfunded liability of LACERA. The blue bars here is investment return. And so you can see in most years from year to year, investment return is having the highest impact on the unfunded liability of LACERA. Perhaps not surprisingly. One of the interesting things when we look at the left, over that 20-year period, cumulatively, the investment return has had a relatively small impact. So over a period of time, the actual return has been fairly close to what was expected. But on that year-to-year basis, you get some volatility there. The second thing I'd like to point out on this chart is the orange bars. And you see on the left, cumulatively, they've had the biggest impact. Those represent assumption changes. And so typically assumptions change every 3 years at the triennial experience. The biggest contributor to the size of those orange bars has been when the investment return assumption has been lowered over time because that increases costs. So 20 years ago, I believe the investment return assumption was 8%, and over time we're down at 7%. And so typically what happens there is when over time, as either the strategic asset allocation changes or the capital market assumptions change, and we have to look at the portfolio and determine an appropriate investment return assumption. And so those have tended to trend down over time as the allocation has changed and as the capital market assumptions have changed. And over time, the capital market assumptions generally came down as we went through those periods of low inflation. But as you move into your next strategic asset allocation, there is some assumption risk there. As you make those changes, when you have a new allocation, whatever the new capital market assumptions are, we'll revisit at that time whether that 7% investment return assumption is still the appropriate assumption at that point. We could move to slide 9, please. So I have a few charts just to look at investment return and the impact it can have. As I mentioned, it's the one that's going to create the largest variability. So we're going to focus on that one a little bit. This is a chart that we presented to you at the March meeting when we were presenting 2025 valuation results. I should have just mentioned as well, all of this is all based on the 2025 valuation. So we haven't built in the 25% fiscal year to date return in here. It's all assuming the 7% from last June 30th. So the bars that you see here, that is our baseline projection. If you returned your 7% every year and all the assumptions were all met, the employer contribution rate for the next 10 years would be those blue bars. So starting at the 25%, dropping down a little bit. And on that baseline projection, we are projecting that we'd reach 100% funded in 2039. One of the things we did, similar to what Tim described for Makita, is we run a lot of scenarios about what can investment return do, because we know it's not going to be exactly 7% every year. And so when we run all our scenarios through our model, and we come up with a 25th percentile and a 70th percentile measure. And so the lines are representing sort of if we returned exactly 9.7% each year or 4.3% each year, what would those contribution returns look like? And so in 50% of those scenarios, the contribution rate is going to be within those two bars, just depending if you get good or bad experience. And so we know that range of volatility is there. Next slide, please. So this is looking at one of our spaghetti graphs. And so what we did here is we went through all those scenarios that we had, and we picked out the scenarios that each, over a 10-year period, each returned an average annual 7%. So if we got to the end of 10 years and we looked back, we could say that, well, yes, we averaged 7% annual returns over the last 10 years, but we know that from year to year, we didn't get exactly 7%. And what could those contribution rates look like? So this is when we start looking at the sequence of returns, and do we get high returns followed by low returns, and what impact could that have on the contribution rate? So the main takeaway from this one is just that 10 years from now, we could be sitting here saying, hey, we averaged 7% return, but you could have had a lot of volatility in the contribution rate in the meantime, just depending on what the individual returns were in each year throughout that 10-year period. Next slide, please. And this one's looking more, again, projecting out investment risk, the bars being the baseline. And now the line is representing, well, what happens if we got a 1-year bad return. And we have put in here a 1-year bad return followed by a couple of years of good return, because we know that oftentimes a bad year is the market will return better after that, and vice versa. And so we've tried to, instead of just showing one bad year and then no recovery, we've tried to show some recovery here. So we've got a negative 7% return in the first year, followed by 2 years of 15% returns. And so over those 3 years, that approximately works out to an average 7% each year. But you can see that just in those, even over those 3 years, you still average 7%. You're still going to get some volatility on the contribution rate as though that works its way through the system and works its way through the actual value of assets. And over time, the funded ratio will reach 100% at a slightly different level as well. Interestingly, on the alternative, it's projected to reach 100% funded a year earlier. And that's primarily driven because in those first few years under this scenario, we're getting higher contributions coming in under that variable scenario than we would have under the stable scenario. Next slide, please. So moving on to talk a little bit about payroll growth and the sensitivity of the contribution rate to payroll growth different than assumed. I mentioned earlier that there's any hiring, retention issues on the employer side can have an impact on the contribution rate, especially as we amortize that unfunded liability. To give you some context, on average, it's about 5.5% of active employees retire or leave employment each year. So that's roughly 5,500 employees. Our baseline scenario assumes that those will be replaced each year. And so you'll have a fairly stable employee base. However, we've measured 2 scenarios here. One that assumes, well, what if there were no replacements for 2 years? So potentially a hiring freeze or just difficulty finding people. And what if we replace those people at twice that rate over the next 2 years? So effectively, the population goes up 11,000 people, up or down 11,000 people over 2 years. And you can see on the green and the orange lines that that then does have an impact on the employer contribution rate. The ultimate difference between those is about 2.4% for that 10 years, 2029 to 2039. And that's largely just primarily based on the fact that the payroll base has changed, and that's what we're amortizing the unfunded liability over. Under all of these scenarios, we're still projected to be 100% funded in about 2039. And that's because the contributions stayed stable to amortize unfunded liability, but the contribution rate as a percentage of pay is what changed. Next slide, please. This takes that chart one step further and introduces just an overall difference in payroll and salary growth. And so this is adding in the possibility that current employees receive salary growth at a 1% higher or lower rate than we currently assume in the valuation. So as well as the overall payroll base changing, we're now getting different payroll increases for continuing active members. And so that has a slightly larger impact because now we're affecting the benefits of continuing members because they're getting higher or lower payroll over time. So similar narrative to what I described on the last chart. You see the difference in the levels here. One thing that we have in here is that even though we're getting different experience here, we're maintaining the assumptions the same. But if we did actually see some experience like this happening, it's likely that we would then change assumptions at some point to try and line up with actual experience. But for this chart, we're assuming that that assumption doesn't change. So you see just some slight changes, some changes in that contribution rate over time as those higher or lower payroll increases, salary increases work their way through the system. Next slide, please. This is a new chart that we haven't introduced before. This is looking at contribution risk, so the sensitivity of the employer contribution rate to a contribution shortfall. Now, as I mentioned earlier, we've got no reason to, no information to believe this is going to happen right now, but we just wanted to get this information in front of you so that you could see what the impact could be if, for example, there was a failure of any of the employers to make their actually determined contribution. And so to model this, we've assumed that, well, what if the employers only paid 50% of the employer contribution rate for each of the next 5 years, so 25 through 2030. And so over those first few years, we're going to get less contributions coming in from the employers. That's going to have an impact on the unfunded liability. So that's going to drive the calculated employer contribution rate higher. Over those first 5 years, you see it gradually increasing there until in about 2031, it settles in at about 5% higher calculated rate than what we would expect under the baseline where all of those contributions are coming in. And the funded ratio in that case would be projected to reach 100% about 8 years later, all due to those lower contributions in those first 5 years. So just gives you an idea of the potential sensitivity there.
Sorry, Craig, we reached the funded ratio at 100% 8 years later under this scenario. Is that correct?
Under the scenario where, yes, for 5 years, there's a 50% lower contributions from the employers, but then at that point forward, then they were contributing at that orange line level, that the actually determined contribution level.
And what's the significance of 2039 for the big drop off?
So because we're amortizing unfunded liability using a layered amortization, when we reach 100%, those unfunded, all those layers can all drop off. They go because you're not amortizing it anymore. And so you drop down to just paying the normal cost, which is the cost of the benefits being earned at that point.
Okay, so it's not the Mayan calendar or anything. So
it's not the Mayan calendar, no. It's the actual Mayan calendar.
Fantastic, thank you.
And there are strategies that we can look at, especially as we get closer to that time, to potentially smooth out those contribution rates, so you don't there isn't that cliff. And so we can, as we go over the next several years and start getting closer to 2039, those are things that we'll be coming back and talking to you about to potentially try and smooth out that cliff, as it's commonly known. Next page, please. So mentioned earlier, the legislative risk. This summarizes Assembly Bill 1383, the main provisions that are in there, generally affecting PEPRA members. The main provisions that are included in there would be an increase in the cap on the pensionable compensation. Currently, for LACERA, it's about 185,000 in that range right now, as that's the maximum pensionable compensation that can be considered for pensionable purposes. One of the provisions is to increase that to the Internal Revenue's 415 limit, which is 290,000. So that would make a lot more compensation eligible for pension. There's a provision in there to increase the retirement formula for safety members up to 3% at 55. And there's also a provision where currently under PEPRA, members have to contribute at least 50% of the normal cost of their benefits. And so there's a provision in there to now allow that to become negotiable, so that it could be bargained that employees could pay less than 50%. All of these changes are likely to lead to increased benefits, likely to lead to higher employer and member contribution rates. And then that could also then have secondary consequences as it cascades through on hiring and retention and levels of salary increase. So a lot of these things are similar to, as was mentioned earlier on the investment side. There's a lot of things can happen that don't just have A happens, so B happens effect. There can be a lot of impacts on a lot of the assumptions included in the valuation.
I think Trustee Mee has a question.
Oh, yes.
Trustee Mee, I'm sorry, I did not notice your hand up. Thank you.
Thank you so much, Chair, and thank you for the presentation. I think these slides also take to the slide 20 when we made the conclusion there about the Bill 1383. Just first thing I want to clearly understand the fact. First, I apologize that I'm not on BOR, so maybe this has been discussed on BOR meeting in much like extensive. So help me catching up here to understanding this bill. So this bill is for pepper plan, safety plan C only, right? So it's not the general member plan G.
My understanding is that the provision for the increased retirement formula would just be for the safety plan, but the increase in the compensation limit and the bargaining on the rates would apply to general members also, is my understanding. Is that
Okay, so this is not just safety plan C, this including the limit, the limits for the retirement calculation, the salary limits, including plan G also?
That's my understanding. I'm not sure if it is. Yeah, thanks.
Okay,
Yes,
was
the
that
general plan G.
Thank you. Was that the same bill that we had a discussion back then in BOR about plan G benefit change? Is it a different bill? Sorry, I know this might not be your question. If anyone have answer, I will appreciate that. Was it the same bill that we had discussion in BOR about, general plan G benefit change, or the different bill?
Looks like we got a relief pitcher.
Yeah.
Please.
Thank you.
Hi, good morning. Barry Liu, Legislative Affairs Officer. So yeah, AB 1383, it's really two things, a compensation limit and then the benefit formula. So the compensation limit applies to Pepper Plan G and Pepper Plan G safety, Pepper Plan G for general members and Plan C for safety members. So that's a compensation limit. The benefit formula is going to change from age 57 to 55. That only applies to the safety members, sheriffs and firefighters.
I was going to say, Ms. Me, that if I remember correctly, the biggest changes are primarily safety and law enforcement, right? I mean, public safety.
Yes, because the biggest change would be the benefit formula, so that's gonna would increase benefits obviously, and then the compensation limit as well. Originally, it was tied to the 415B a benefit limit, but since then it's been lowered to basically the current Social Security wage base. Essentially, it's resetting the wage base to the current wage base, and then that's going to be subject to COLA increases going forward.
I see.
Did that answer your question, Ms. Me?
Kind of answer my question. I do get more educated. Thank you so much. I do like from the equity standpoint, right? I do wish, was the same equally applied to both safety plan C and general member plan G, because that's the plan that two plans that got affected by Pepper, back then the governor reform, right? So that's one thing I think is important because look, not just safety members. So I look at LACERA, look at our investment team starting from there, that we'll talk about attraction, retention, right? So I know we have no problem with that because we have excellent leadership of Mr. Graver there, excellent team there. However, this is thing that will affect them, most of the people there, and affect most of the managers, in LACERA, and more broadly, LA County leadership. So a lot of people will get impacted by the salary limit there. So just Plan G myself, might not impact me, but I'm thinking like it would be great, if this bill was more, equally applied, to both groups, it would be more pleasant to, hear that. But it's okay. It is what it is, and it's not our decision, right? Whether the bill pass or not pass. So I just wonder, was there any analysis showing, the scale impact to the employee contribution if the bill was passed, right? I know it's going to impact us, but the scale of impacts, do we have an analysis in the measurement of dollars amount or percentage, things like that? That maybe I'll apologize again if it was audio percentage BOR.
Right, and through the chair, Trustee Me, thank you for that comment. So this bill was introduced last legislative session at state level, and has picked up again this year. And we've been sort of optimistic here. Cautious here internally at LACERA. Barry Lewis and I have talked, and we didn't want to do any projections per se on this until it became sort of more in a final format. So I know the bill has gone through and I know there's been some significant changes. Once the bill is in a format where it looks like it's either passed or we can do some calculations, I'm happy to do that for the board. Milliman has already volunteered to do that. But at this point, we were just sort of being cautious about it. So that's why you haven't seen any numbers as of yet.
Yeah, I understand your reasoning. So we're just thinking on the other side, people that are making decision on that bill, right? Would that information be helpful for them to make prudent decision? Just a thought, might not be our job, but just a thought. So that's go ahead.
Yeah, sorry, Trustee Mee. To address that, I believe that Sackers, using Siegel as their consultant, had put out some analytics and some worksheets that funds could use. And I believe that Sackers calculated and provided some information that is available out there. It's a little bit more general. Again, we like to focus on LACERA specific information. So, we didn't really dive into that, but I believe there is information out there for people to look at.
Got it. I'm glad Sackers on top of this. Thank you so much for answering my question so far, and appreciate the presentation too. It's really informative. I know it's our board's job, to make sure our fund is long-term sustainable, and also it's our job, our decision to make, for employer contribution rate. So I'll give the floor back to the chair and then Milliman. Thank you.
Thank you, Ms. Mee. Ms. Langton.
Good morning. Can we please go back to it's any of the slides, 11, 12, 13, or 14, where the drop-off, where we talk about the drop-off. Can you explain that to me again, please? I'm not completely understanding, like on line or slide 12, does the orange line end there? Or is it underneath the green and I just can't see it?
It's underneath the green line there.
Oh, okay.
Yeah. And so effectively at that point, so the contribution rate is made up of the two pieces, the normal cost rate and the amortization of the unfunded liability. But when the unfunded liability reaches 100%, there's no need for that portion of the contribution anymore. And so the contribution rate would fall down to the normal cost level. And under each of these three scenarios, that's all projected to happen at the same time. And the normal cost rate is projected to be the same under each of those scenarios.
So is that likely to happen?
That's where we get into the crystal ball.
Oh, okay.
So it's because this is assuming that all of these assumptions are met over time. And so we hope that our assumptions are reasonable and they're good based on our judgment and our opinion. They're a good estimate of what we expect to happen over the long time. And over the last several years, this trend has certainly been holding up, that it's been getting shorter over the last few years as there's been primarily good investment return. But whatever happens going forward could impact that unfunded liability, and so could change that effect. And investment return is the biggest risk to that changing.
Okay, and can you also, thank you, that was very helpful. Can you also explain why mature plans have more risk? I would think it would be the other way around.
So mature plans, once you get the level of liabilities, but the payroll, the active employees, the level of payroll has stayed relatively stable. So you have a lot more assets relative to the payroll that's supporting it. Another way would be to think of it as you've got a lot more, as the ratio of your retiree population increases, so that you get a lot more of a one-to-one relationship, similar to Social Security. In the past, we had a higher relationship, higher number of actives supporting the retiree population. That ratio has gotten a lot smaller. And so we now get a lot more volatility, because if anything happens on the asset side, it has to be, the makeup of it has to be borne over the active population's payroll.
And so what do very mature pensions do about that?
So LACERA has been making a lot of steps to try and address that volatility. A lot of it is dealt with through the investment allocations and trying to adjust the level of risk that we're taking there to try and manage that. That's the main driver, the main sort of lever that you have there to try and address that. It is a challenge for all plans, and especially because investment return is the highest risk to all these plans. So that's the one that you can manage the best.
Okay.
So let me, and I was going to actually, if you don't mind, through the chair, I was going to make this point at the end of the conversation, but I think it's a good spot. Strategic asset allocation, I think Craig said that in short. I think the board also has a couple of other good measures like annual evaluations. We're measuring the liability every single year. Also the experience study, we're doing that every 3 years, right? We just did that for 25. The next one will be for 2028. Nick, Craig, and Alan will take a look at the new asset allocation at that time and factor that in. Also, there are measures in place each year when Nick and Craig do the valuation, whereby if things are, again, off the rails, they'll take a look at that. They'll come back to the board and say, hey, this thing seems out of alignment. Maybe the payroll growth is just way above what Nick and Craig were projecting. So there's some measures built into the board's process and the board's policy currently as exists to keep us sort of in alignment and monitoring the liability side.
And then my last question for Craig is, do you follow soccer?
I do.
Okay, and I forget, are you from Scotland?
I am, yes.
Okay, so that's your team?
It is. I'm going
Okay.
out to Boston next week.
Oh, nice.
For-
Okay, okay. Portugal and USA, just saying, but okay, all right. Thank you. And thank you, Craig, because the novelty of your accent just makes this actuarial so much more pleasurable to follow. So thank you for that. Thank you.
Thank you.
They'll never take our freedom. How does it go? I don't remember that one. But. All right.
So I just have a couple more slides and I will let you off the hook with this if I may.
Okay.
If we could jump to slide 16, please. So I mentioned earlier, and we just mentioned there, there's a level of assumption risk, especially on the, or in this case, looking at the investment return assumption, is it's lowered from 8% to 7% over the last 20 years as you continue to make strategic asset allocation decisions and as capital market assumptions continue to change. That's what we look at when we are determining the investment return assumption that's appropriate to use. And so this chart here, and this is included in the valuation report as well, just gives you a sense of the sensitivity of the contribution rate to a change in that investment return assumption. And so essentially, current assumption is 7%. If that was to move to 6.5% or to 7.5%, the employer contribution rate would change by somewhere in the region of 5 to 5.5%. So that's from 20.4% employer 25.7% down to 20 or up to about 31%. And the funded ratio would also change by about 5%. So that's the sensitivity to that assumption. Next slide, please. Focused a fair amount there on employer contribution rates. There are also some risks to the member rates. As a reminder, PEPRA and legacy members rates are determined differently. And so, but the one thing that's similar about them is when we're looking at the member contribution rates, they're forward looking only. The member doesn't share in any of the unfunded liability rate. It's just on the cost of the benefits. And so the assumptions and what we're expecting going forward do impact the member rates. So when we did the experience study last year, there were some changes to the legacy member rates. And each year there tends to be some changes to the PEPRA member rates because they're just based on 1/2 of the total calculated rate. And so that tends to move a little bit over time. So there is some risk to members, particularly through the assumptions and whatever the assumptions are. And on Assembly Bill 1383, that affects the PEPRA members, any changes there are also going to have an impact on member rates as well as employer rates, as if the current provisions were to be passed. Next slide, please. Just to touch on a couple of the other risks that can have an impact that we haven't shown any quantification for here. There's the mortality, there's a big assumption for mortality. Obviously, we are projecting how long people are going to live and receive their pension benefits. There is a lot of information and studies out there on mortality. So we tend to get relatively small variance on mortality from year to year, and we do adjust that typically at the triennial experience study to reflect most recent experience of both LACERA and any published tables that the Society of Actuaries have come out with. The biggest risk really to LACERA on mortality is that there would be some medical breakthrough that could result in much longer life expectancy, and that would lead to significant increases in cost for LACERA and all other pension plans as well. And I mentioned earlier in the retiree COLA, that is linked to local inflation, but there are some caps on the retiree COLA, and those assumptions are built into the valuation. And so typically we see very little impact on the valuation from year to year as inflation changes there from the retiree COLA. Next slide, please. So Ted mentioned briefly a few minutes ago that there are some processes in place to help to manage this risk. And he mentioned the strategic asset allocation studies and the regular experience studies and the annual valuations. And so these are all things that the board, LACERA and the board are already doing to help monitor, manage, and address risk as we go through. And so hopefully we're doing this at regular enough intervals that we're continually updating based on whatever's happening and based on new expectations for future. And to wrap it up on the next slide, please. There is a mature plan, so you are subject to a lot of risks that come with that. As we discussed, the investment returns typically have the biggest impact on funded ratio and employer contribution rate over time. Currently, legislative risks are on AB 1383. It's out there. We are paying attention to that. And as Ted mentioned, we are in discussions with LACERA about the appropriate time, if there's an appropriate time to do some additional analysis on that. But we believe that with all the mechanisms that you have in place to address risk, and you can't eliminate it, you can only mitigate it. But we feel like these processes you have in place are doing a good job of managing that right now. That is the end of my prepared remarks. I'll be happy to take any additional questions.
Any questions from the panel? Seeing none, I'm going to thank you for a very extensive report.
Yeah,
thank you.
Great, thank you.
All right, so I believe our last report will come courtesy of Mr. Stephen Rice. Is that right? Oh, no, all right. I thought we had another presentation. All right. Yeah, that's great. So that concludes item 9. Let's go through the rest of the agenda. Item 10, items for staff review. Seeing none, item 11, items for future agenda. Seeing none. Item 12, good of the order. I'm going to ask if any trustee has items for the good of the order. We're not going to go around. Just if a trustee has something, raise your hand. Nothing for the good of the order. I love your brevity, trustees. That's great. All right, then why don't we take a 8-minute break, 5 to 8 minute break before executive session, and then we'll come back and do executive session. Everyone can stretch and do whatever they need to do, and we'll be back at 10:50 on the dot. Thank you.